Now, I give an example. People talk about sometimes setting money aside for retirement as gambling. And I think it is for a lot of people because of how they go about it.
There's a way you can do it that makes it more like gambling. Absolutely.
Yeah, and especially moving money into the market. The way Jim Cramer does it, gambling. But think of it this way. When you go to Vegas, you're going to gamble. Okay? When a casino develops a new property, they don't call it gambling. They call it investing. Why? Well, let's think about a disciplined investor. If, let's say, all you did was invest in the U.S. market and all you bought was the S&P 500, which is not a strategy we'd recommend at strategy.
all. but for simplicity's sake, we'll talk about it.
Yeah, you look at the S&P 500 the last 40 years, you could take any day of the year, pick it, and then pick a day 1 year later. It will be higher more than 75% of the time a year later. That if you were thinking about it like a casino, that's like the blackjack dealer winning versus the blackjack player. And that's the key. That's what we want to make sure we're doing is just, it's fine. You know, I was re-listening to our interview with Scott Adams a couple of years ago, Corey.
Yeah.
And one of the things he talked about is changing your language can keep you from making mistakes. And changing our language to simply say, like, if you want to do some stock trading, do some stock trade. Just don't call it investing because it will fool you. Language is so powerful. Just say you're speculating. I'm going to take $10,000 and speculate. Or I'm going to take $10,000 and gamble. And that way you don't ever get it confused, because you could have a couple good year run with your $10,000 and say you grew it to 40. That's amazing. But that doesn't mean what you want to do is take your $4 million and do that, because you're still speculating. And just like somebody can gamble and be up, they can end up back down in a hurry. But if you're investing, you can do something about it. You can have strategy of how to recover, et cetera, when the market goes down. And Corey, that brings me go ahead.
I was just thinking this: a year later, 75% of the time, you're higher. That's better odds than the house has on roulette, isn't it? Because the house, it's a little better than 50-50 for the house because of the two greens.
Yep. Well, the zero double zero makes it way better for the casino. If they had just 1-0, then that's their smallest amount of profitability. But it is better than roulette. It's an amazing thing when you can hold the strategy of being a disciplined investor. But what does it take to be a disciplined investor? It takes discipline. Oh, what builds discipline? Knowledge. So if you're not digging into something like this podcast, if you're not looking at the historical returns, if you're not meeting with your advisor to really understand what's happened in the past when people do try to move their money in and out, I mean, the biggest condemnation of why active management doesn't work will not be talked about by the financial industry. And that is because they're selling mostly active management. So how can they tell you you can't possibly outtime the market when they're selling you funds, selling you on the fact that some guy or gal or some amazing hedge fund in a very tall tower in a big city with marble floors and like 8 screens are trading and is somehow outpacing the billions of people in the free market that are exchanging and setting those prices? They can't tell you you can't do it because nobody can. They have to say you can't do it because you don't have the research department. The people with the research departments can't do it.